it's time for us to start our next session. Today, I'm very glad to introduce to you Dr. Juan Montermoso, Professor of Marketing at Santa Clara University. He is also a co-director of COO Forum, which I hope will tell us a little bit about. And he also teaches in Stanford's program in Advanced Project Management. So we will, without further ado, give him a word and ask him to tell us about the topic of his lecture today.
Okay. Thank you. Thank you. Dobre utro? Is that correct? I kind of my Russian is very limited, so please bear with me. Thank you. Thank you very much for being here on time. I must confess, with all these microphones, and these things, I feel a little bit like a cosmonaut. You know, you're waiting for ground control to tell you what to do. My name is Juan Montermoso, and you can read my biography. Maybe to give you a little more background, I have been here in Silicon Valley for almost 40 years, 35 years. And I have worked with a lot of high-tech companies. My major career effort was with a company which I think many of you know as Hewlett Packard. Now it's called HP. We made computers, personal computers, printers, computing technology. I also worked abroad at Asia, Southeast Asia. My parents are from the Philippines, and so I was based in Manila and worked in Southeast Asia region, Singapore, Malaysia, Indonesia, Thailand, Taiwan. And when I resigned from Hewlett Packard, I subsequently joined the faculty of Santa Clara University. So that's where I currently am. I also engage in a consulting practice. I work with many clean tech companies, startups, advising, mentoring, sometimes judging contests and so forth. So today, I hope to share with you some of my perspective, both from a large company, technology company, where the industry is going, and also from a small company, startup perspective or viewpoint, to give you some better idea of how small companies can grow to be big ones, just like Hewlett Packard. Okay, so I thought maybe the topic, of course, is finance and accounting. And the talk today is about financial factors in startup decision making. But by the way, am I talking too fast or too slow? If I'm talking too slow, let me know. I will speed up. Okay. All right. Thank you. All right. I'll speed up a little. So what I wanted to make sure we covered were some of your questions or your interests. So I'd like you to take 3 or 4 minutes right now. Have you been divided into groups already? Okay, you're in groups. Okay. Okay, group 1. You're group 1, 2, 3. Okay. So can you divide up in your groups and take 3 minutes to discuss among yourselves the 2 most important things you would like to learn about financial factors in startup decision making. There are many things we can talk about. We may not touch on all of them, but I want to see and make sure that we cover what's important to you. Is the exercise clear? Okay, so come up with 2. If you want 3. Yeah, finance and accounting. Okay? The 3 things you think you would like to know more about, especially if you are involved with a startup. Okay? Go. Okay. Time is up. Let's go around to each of the groups. I asked you to give me 2 topics or 2 areas that you were interested in learning more about. So I'm going to write them down here so that we don't forget it. Okay? I think we in 3. Just give me 1. Preparing finance model. Okay? Team 2. Just give me 1. How to evaluate the cost of a project. And there are a lot of factors. Okay? Team 1. This one. Okay, give me your second one. IP licensing. Evaluation. Okay. Let's go back to team 3. Did you have a second one? Financial analysis of what? Of the market. Okay. Okay. Team 2, did you have a second one? The cost of software. Cost of software. What did you mean the price? The cost. Okay. Okay. All right. Um, oh, the price of software. They're very different. Very different, right? Okay. Anything else? Anything else? The what? Estimation of margin. Okay. One more. Definition of market size. Okay. Great. Thank you. Let me proceed then. Okay? What I hope we will be able to do is cover some fundamentals, some basics of finance and accounting. And as we go through it, you'll begin to see how some of these relate. Okay? And as we see that relationship, we can go deeper to try and understand what the details are. Okay? Let me also caution you, you will not get all your answers today. Okay? What I hope you learn allows you to go to be able to find what the answer might be and to evaluate what the answers are. Okay? So it's less important that you have the final answer, but that you know how to look for an answer because you understand finance and accounting. Okay? Fair enough? Okay. By the way, this is meant to be it was billed as a lecture. It's not a lecture. It's an interactive dialogue. So if you have any questions, raise your hand. Okay? I'm here till after lunch. I think we have more than enough time to answer questions you have, to deal with these, and then also to talk about the topic. Okay? You all have copies of the, yeah, if I may, you all have copies of the slides. So if you have any question, you take notes. If you have any questions, further questions, we can talk about those further. Okay, let's begin. So, what do we hope to cover? This is an overview of the topics that we will talk about this morning. We'll talk about some of the tools to put together your financial statements, including, let's make sure I do that, including revenues and costs. And we'll talk about variable and fixed costs, and of course, profit. You'll notice already we're going to address costs. And as we talk about revenues, we will need to talk about the market and the market size. Okay, we'll talk about, someone said the financial model, okay, is right there. We'll start with some initial understanding. And then we'll talk about how you look at a project, how to evaluate the project as a whole. Not just understand the cost, but also something called the time value of money and the net present value. Okay. We'll also talk about the impact of the project. That's what we'll cover. We'll cover a lot of these hopefully by the end of the morning. We'll have lunch, and then after lunch we'll have an opportunity to review some of them, ask questions, cover these topics that you brought up. Okay? Good. So tomorrow you will be meeting with another expert from Silicon Valley, and both of us use this model for how we look at the business, startup business as a whole. I'm not asking you to remember all of this. It's based on an article called The Lean Startup by Stephen Blank, a professor and entrepreneur, a professor at Stanford and also an entrepreneur. And he talks about some of the important elements in a startup, such as knowing who your customers are, what value you bring to the customer, how you reach the customer through channels, what your resources are to deliver whatever it is you offer to this customer segment. But I call attention to two boxes that are important: the revenue stream and the cost structure. Okay. It is important when you have a startup to understand what the dollar impact is, what the revenue impact is, and also what costs are, determine in the end if in fact you make a profit. Okay. There are some questions here. For what value are our customers really willing to pay? So already we begin to see, how will you evaluate the price of the software? Okay. The price of the software depends on the value that the customer is receiving. Is the customer saving money? Then the value. You should price according to what the customer saves. Is the customer generating more revenue from the software? Maybe you should price according to that revenue. Yes. Yes. So you are correct. Some of the value is intangible. For example, perfume. What's the value of perfume? It's just water with some fragrance. But it's a value for your partner, right? When you give it as a gift. So it is intangible. What we will talk about is how we might monetize, okay, or turn some of those intangibles into tangible, okay? Not every intangible can be monetized, but in fact, for instance, savings in time, better decision making might actually be monetized, okay? All right. Let's continue. So I want to emphasize this model says revenue and cost are important, and that's what we want to talk about. Now, I want you to get back in your groups, but I want you to think about this. And I'm going to ask you to actually write something. Okay. Imagine, and this is just an example we will use today. Imagine that your startup makes this box. Okay? Why will you make this box? Why will you offer this box to a customer? Because you run a packaging company. You sell the boxes to another company which puts their product inside the box and ships it to the customer. Okay? So this is business to business. Is that the business you're in? If you make software, sometimes you sell to a business. If you make hardware, sometimes you sell to a business. So it's very common. In fact, 70% of the world's economy is actually business to business. There's a lot that goes on. Now, I would consider the following questions. What does your team need to start your business? And then what does your team need to continue to run the business? Okay? So, for example, do you need to make the box? Another example, do you need people to work on the equipment? Okay, so think about those things. I would like you to take one of those sheets in your group, and I will ask you to write down those, to think about those, and then write down whether the impact is on revenue or cost. Does it bring money in, or does it cost you money? Is the question clear? No. Okay. Okay. Right. Okay. Okay, so when you buy the equipment, is that a cost or is that revenue? Cost, okay? So I want you to think about every activity. Every activity, does it cost you money? Does it bring money in? All right? Now, the only time you bring money in is when? When you make a sale. Okay? So most of this will be about cost. Okay, it's about cost. Okay? All right. Is that clear? Okay, so we'll give each table a sheet. Okay, can we rip off a sheet? Okay, and I'll give you a pen. Okay, one more. Okay. Here you go. Make sure this is sticky, so make sure you put it on the correct side, because we're going to put it up. Here you go. Only 2 on your team? I thought 4. Oh, coming. Okay. Theoretically 4. Okay. All right. Okay. You have a pen? All right. So I want you to write down what you need to start and continue your business, and then does it impact cost or revenue? Immediate. Immediate. So you have 3 minutes. This is your product. Okay? Do you have to tell customers about it? This is your product. Do you have to tell customers about it? How will you do that? So expense? Is that a cost? There's no right or wrong. You just have to think about. Hmm? Okay, time's up. Can you take your sheet and let's put it here. Just put your sheet here. Bring your sheet up. You can come up. You don't have to sit at your table. You come up. Very good. Yeah, anywhere. Giants. Okay. Can you put it here? Maybe one more here and one over there. Sure. Go ahead. Okay, you can gather. You don't have to sit at your tables all the time. So let's look at these. Okay? Are there any that are common? Okay. Materials. Materials. Labor. Okay? Okay. Human resources. These are known, especially when it's called direct labor. Those are called variable costs. Variable costs. And why are they called variable costs? Okay, depending on how much you make, it changes. And of course, how much you make, you hope you sell. So as your revenue goes up and down, your variable costs go up. How about promotion? Fixed costs. Okay? Fixed costs. Okay? How about HR? Public relations? Fixed or variable? Fixed. Same. Right, so this is the same. Okay? Okay, what does production consist of? Labor and material. Okay? How about salary? Whose salary? Whose salary are you talking about? Are they the only people in the company? There are two groups. One group is direct labor. Their cost is variable. The other cost, which is fixed cost. And who is a fixed cost? Administration. Okay. Administration, R&D, finance, IT, all fixed costs. Okay? So security, okay? So maybe this is mostly fixed, some variable. Okay? How about transport and logistics? Why? Yeah, it depends on the product, but for the most part, it's this. Okay? So this would be variable. Okay? Now let's go over here. Where do we look for revenue? Okay, we sell the products, and what's the basis for our revenue? One is the price. What else do we use the price? Quantity. Okay, so price times quantity equals revenue. It's as simple as that. Okay? All right. Now, what is this? Why did this group put patents? Oh, the patent. Okay. How many patents do you have? One patent? One patent? You just have to set a price. So we use the same formula. Okay. So you can sell it multiple times. Okay. So you would sell many copies. Same patent. One price. Could you sell it for different prices? Possible. Okay. You can begin to see your revenue based down to price. And what is this? Distribution. Oh, I see. To multiple customers. Okay. All right. I think more or less we've covered what other. Oh, okay. Here, marketing. Fixed or variable? Fixed. Okay. Okay. Rent. Fixed cost. Fixed cost. Okay. Okay. Equipment. Okay. Now, very important. Equipment. You buy a big machine for one time, $10 million. Okay. That's a big cost. Do you consider that a fixed cost or a variable cost? The answer is neither. It's a capital cost. Capital cost. You're investing. Okay? So how do you reflect the cost of the equipment on an annual basis if you use the equipment for 10 years? Amortize. The amortization of equipment is called depreciation. Okay. Oh. Okay. 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 Yes. Okay. So think about it this way. All right. If you buy a piece of equipment and you use it over a long period, let's say 10 years, and a building also, okay, you use over 30 years, buildings are 30 years, you want to reflect the cost of that building or equipment every year. But it's not correct to take the entire price of the equipment in 1 year because you're getting 10 years of value. Divide it into 10 years. So whatever the cost of the equipment, $10 million divided by 10 years, 1 million a year. So that's the cost associated with the equipment. That cost is called depreciation because the value of the equipment declines 1 year, $1 million. How much is the equipment worth at the end of 10 years? Very good. 0. Okay? So no value. Okay. No value, but you could still use it. Right? So it's not quite the physical use, but it's an approximation. Now, amortization in the Valley is used primarily to talk about paying off debt. Okay? So if I borrow money, I borrow $10 million from a bank, and then I pay it back $1 million a year, the value of that loan goes down $1 million. Very similar to depreciation, but it's called amortization because I'm paying off the loan. The money is going out. I actually pay cash. Okay. Depreciation, lowering of value, but no cash. See the difference?
There is another component of amortization, at least in their accounting books, is that presumably you would want to replace your old equipment with new equipment. So every year you make amortization payments to your saving account.
I see.
In amounts that will be sufficient at the end
To
of the cycle to purchase new equipment.
Yes, yes. That's certainly possible. No, no.
Смотрите, амортизационные отчисления, которые вас учили на курсах бухгалтерии, если вы на них были, связаны с тем, что вы по истечении цикла использования оборудования хотите его заменить новым оборудованием. Поэтому ежегодно вы отдаете в банк, фонд амортизационные отчисления в необходимом количестве, чтобы, сейчас я вам дам слово, чтобы собрать ту сумму, которая вам понадобится для приобретения нового оборудования.
Сейчас
I see. Okay. Yes, yes, we can. Okay. Okay, yeah, okay. So here's it is a good discussion, but you can work that out with your accountants. Okay, what's important? Okay, what is important? What is important about this exercise? Your revenue comes from price and quantity. Your costs are fixed or variable. Every cost can either be variable and capital. Third, but the capital cost through depreciation becomes a fixed or variable cost. Yes. No, only into price. Okay. Question. Mhm. Generally speaking, promotion is considered a fixed cost. But the way you said it may be approximated as a variable cost. Let me give you an example. Let's assume you're promoting a new product. Okay? So you estimate how much you're going to sell. Say you sell $10,000 worth of the product. So you'll say, I will spend 5% on promotion. 5, okay? And that's fixed. But if you estimate 20,000, someone else estimates 20,000, they say we'll spend 5%. Then 5% of a larger number becomes a larger fixed cost. It's still generally fixed. Okay? Sure. Yes. Okay. Yeah, yeah. Yeah, yeah. Oh, you're talking about the company. 18 billion was the cost of the company. Yeah, it's not the cost of the software. The software is free. Yeah, what about it? Well, if you go into a store, you can buy Microsoft Windows, the operating system. I think it's like $100 or $200. But if you talk about the value of the company, it's very different. And we'll actually talk about that. Okay? So if you could take your seats. Have I gotten louder or am I okay? Can you hear? It's okay? All right. Okay. Let's Okay. Okay. So, there we go. Very simple, this is it. This is it for finance and accounting in a sense. This is what you want to know. Okay? If price times quantity is your revenue, take out your costs. Some are variable, labor, material, some are fixed, and you get what's called operating profit. Now, I've simplified it a little. I haven't talked about interest if you borrow money. I haven't talked about taxes, very important in every country. But most decision makers, they worry about this first, and then they let the accountants think about taxes and interest. Okay. There's something called break-even analysis. And what you need to know about break-even analysis is the fixed cost, the variable cost, and the price. Okay. And the way you arrive at break-even is you take your revenue, the definition so we don't forget that. The definition of break-even, when revenue minus total cost equals 0. It's known as break-even. Break even. By the way, are any of you mathematician, scientists? Okay, okay. All of you have taken algebra, mathematics. Revenue equals total cost. Revenue is price times quantity. Total cost is fixed cost plus variable cost times quantity. That's why it's called variable. Therefore, price times quantity, price times quantity minus the variable cost times quantity equals the fixed cost, or price minus variable cost times quantity equals the fixed cost, or quantity at break even equals the fixed cost divided by price minus the variable cost. Just simple math. Okay? What's the fixed cost? 1.5. What's the price? 0.6. What's the variable cost? 0.3. Therefore, the quantity at break-even is 1.5 divided by 0.3 should be 5 units. Okay? Graphically, this is our fixed cost, this is our variable cost, this is our revenue right here. This point is known as break-even. So what this says is you have to sell more than 5 in profit. So what does a startup try and do? Get above break-even. How do you get above break-even? You set a price and you have a quantity. To get quantity, you need customers. No customers, no quantity, no revenue, you're going to lose money. Any questions about that example? Okay, I think it's also in your slides. Yes, question. A service product. Yes, because. Okay, if you provide more service, did you charge more? Okay, so you, in essence, you raise the price. Okay. Oh, I see. Okay. Yes. Yes. Okay. It's either one or two. Two or three. Okay. Correct. Okay, so one of the ways to do it is to look for the break-even revenue. You change the formula to calculate the break revenue, not the break-even profit, okay? And then you have to find how do you generate that revenue. For instance, in your example, you can only sell 2 or 3 of the software, but is that the only way you generate revenue? Are there additional things you can do to generate revenue? Can you offer training? Can you offer support? Yeah, yeah, yeah. Yeah. Can you have more than break even? Yes, yes. Okay, so, right. The the goal of this analysis is to tell you at what point you will approximately make or lose money. This is all in the future, right? You haven't sold anything yet. So this is only telling you, I think I should try and find 5 customers. If you find 6, that's better. 7, even better. But if 5, you might be in trouble. If you only have 4, then you better find either another product to sell or another customer. That's all this tells you. Okay? Okay. Can you, in your groups, can you figure this out? Here's the formula. The quantity at break even is the fixed cost divided by the price minus the variable cost. So in your groups, this is the information. Price. Here's the variable cost. Here's the fixed cost. What is the break even quantity? Can you calculate that? In your groups. You can do it as a group. You don't have to do it individually. Question? Oh, okay. Go ahead. Okay. When you have an answer, raise your hand. Oh, you already have an answer. It's fast. Okay. Okay. Let me just okay. The answer is quantity at break even equals fixed cost divided by price minus variable cost. 10,000. 5 minus 3. 5,000. 5,000 what? Units. 5,000 units. How much is it? $5 each. So the break-even volume so if you're selling 2 or 3, you can look at this, right? And if you only sell 2 and your break is more than this, you can look at how many more dollars do you need to sell. Okay, I forgot. What's the national currency of tenge? Okay, tenge. Okay, I apologize. I use dollars because we're in Silicon Valley. Okay, Any question about break even? So what do you know so far? You know your costs have to be fixed or variable. You know you generate your revenue through quantity or price, and you know how to calculate break even. Okay, let's move on. There's another statement. Oh, yes, question. What? Yeah, that's the revenue. Okay, so what we've talked about so far has the profit and loss statement. Most startups pay attention to. But there's another document. There's another document that's also important. It's called the balance sheet. And it consists of three components. One component are called assets. These are things that are owned and that have value. Things like cash and inventory, equipment. These are things that are called assets. And there's the definition, we can sell it for cash. They have value because we can get cash for them. All right? There's another set of elements called liabilities. Those are things that are owed, accounts payable and debt. Okay, that's what you owe. Okay, these are claims against the assets. All right. Then what's left is what belongs to the owners. Okay, that's called equity. Okay. Now, the important thing about a balance sheet is that assets equals liabilities plus equity. This is what a lot of people pay attention to. So the question earlier, someone asked about Microsoft. Okay, the product itself sells for a certain amount of money, but Microsoft as a company is worth something. What is it worth? One way to determine what it's worth is to ask what is its equity. Okay? Because in a balance sheet, assets has to equal liabilities plus equity. Another way of saying that, what is owned must equal what is owed plus what belongs to the owners. This is always true. If this is not true, there is a problem with your accounting. This goes back to the 15th century. It was called double entry bookkeeping. Of the Europe invented this. And what they said was, if you have something owned, it either belongs to the owner or you owe money on it. Make sense? Okay. Okay. So for instance, you own an automobile. Okay? You buy it. $15,000 for an automobile. You pay cash. Who owns the automobile? You do. So you have the entire equity, asset, correct. Correct. The car is the asset, you own it. You're the owner. Now, suppose instead to the bank and you said, I don't have $15,000. Lend me $10,000 and I will get the 10,000 from the bank and 5,000, 15,000 to pay for the car. The asset is still 15,000, but now what belongs to the owner is 5. What is owed to the bank is 10. Correct. Zero. Thank you, Arthur. Yeah. Still the same. The asset is the same. Yeah. Okay. Okay. Assets equal liabilities plus equity. Okay. What's owned is either owed or belongs to the owner. So, I'm going to show you, this is a large company because it's traded. We can see their balance sheet. I just want to show you something. Look at this number here. Total asset. Look at this number here. Total liabilities. Are they the same? Because assets equal liabilities plus equity. All right? What are the total liabilities? 48,185. What is the equity? 56,943. Okay? So in this example, 56,95943 plus 48,185 equals the assets 105,10528. That's the balance sheet. Okay? That's why it's in balance. There are many details, okay? But the balance sheet has to balance. Understand? Okay. Now, question. Have you ever heard the term okay. How do we calculate it? I'm sorry, I didn't. Okay. Return on equity is equal to net income divided by equity. What's the equity on this balance sheet? Okay. What's the net income? The answer is you don't know because it's not on this sheet. You have to look at the income statement. Net income, 6,392. And the answer is? Someone has a calculator. Thank you. 11%. 11%, more or less. Okay? All right. So, well, that's exactly the question startups always ask. Okay? Okay? So is this a good number or not? Okay. What? Okay, here's the way to think about it. The owners put some money into Merck. And what was their return? 11%. Okay. What else could they have done with the money? They could have taken their money and put it in the bank. How much would they have earned at a bank in Kazakhstan. 7%. Is 11% better than 7%? So this is good. Okay. The way to think about it is, what can you do with the money if you didn't invest it in the company? Okay. All right. Now, suppose they were only making 4%. Not good, right? So what would Merck do? What would this company do? What? They would reduce their costs or increase their revenue so that they could have a higher return. Isn't that what you do with a startup? Okay. But notice, in order to calculate that return, you need two documents. You need a profit and loss statement, an income statement, and you need a balance sheet. Okay. Yes. Go ahead. Yes. 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 Correct. Possibly. It depends on whether the company wants to take their earnings and pay it as dividends. Theoretically speaking. Correct. How? No, directly. Directly. Okay. So you take their net income and you divide it by the number of shares. Okay? So let me just illustrate. You take their net income. Maybe I should do it here so that it's more visible. You take net income and divide it by the number of shares. Okay? And you get what is known earnings per share.